Joining me now to take a closer look at Asian emerging markets, in particular Southeast Asia, amid the challenging global environment, is Sanjay Mathur, Head of Economic Research for Non-Japan Asia at RBS in Singapore. Sanjay, before we go on to discuss several Asian emerging markets in more detail, looking at the challenging global backdrop ahead, talk me through some of the headwinds Asian currencies face and the major downside risk facing these economies.
Yeah, I think that the global environment has been challenging and is likely to remain challenging. And we've seen Asian economies react to it. We've seen slower growth rates across the region. Having said that, I don't think that at this stage growth is that weak that it warrants some kind of depreciation of Asian currencies. We are not that very positive on Asian currency at this point in time, but I do believe that for us to expect that central banks in the region would be intervening to weaken the currency to support exports is still quite distant right now.
Now, interestingly, the Monetary Authority of Singapore uses the Singapore dollar exchange rate rather than interest rates as its main policy tool, and also resisted from adding monetary stimulus last week. In this current environment we're in, is this still the best policy for the central bank to adopt in order to spur growth, keep inflation under control, and manage the competitiveness of its exports?
First of all, this policy has been in place for a very long period of time, almost since the mid-1980s. The concept of an exchange rate-driven policy for Singapore was that it's an extremely open economy. Singapore largely imports prices from the rest of the world because of its openness. Second, it is a financial hub, and therefore it has a very open capital market, and under those circumstances, an exchange rate policy is the best. It is true that in the last 2 years, the kind of inflation we have seen in Singapore has generally been in the non-tradable sector, property, cars, automobiles, etc. Now, all of these are driven by domestic policy settings. So, in that sense, the exchange rate policy continues to work very well. The second point I think which is important in this regard to highlight is that we are changing character now. Singapore is no longer that dependent on manufactured exports as it used to be 10 years ago.
Well, despite Singapore's economy shrinking by 1.5% in the third quarter, it did manage to avoid a technical recession. What is your current outlook for the Singaporean economy, and what driving factors do you think will be behind the performance?
Yes, I think that we are forecasting very, very mediocre, if not poor growth for Singapore, both in 2012 and 2013. This largely reflects the fact that non-oil domestic exports will trade on the very weak side. What is going for it, I think, is really the services side, which when we look at tourism, we look at the education industry, we look at the financial services industry. These continue to chug along nicely. These are some of the structural changes that are taking place as opposed to something that's more cyclical in nature, driven by external events.
Well, a lot of Asian countries have seen their trade balances deteriorate amid a slowdown in consumer demand and investment. Taking big Asian trading powerhouses such as South Korea, Taiwan and Malaysia as an example, do you think emerging markets need to rethink their export-reliant growth models? And if so, how?
The very fact that you mentioned the trade surpluses are coming down is a reflection that there is greater emphasis on domestic demand now. If you focus on Southeast Asia in particular, Thailand, Indonesia, Philippines, Malaysia, you can see that the share of consumption, the share of investment in GDP has increased. Likewise, we are starting to see a similar phenomenon in China, but it's going to take a much longer period given the the scale of transformation that's required.
Now, Malaysia is reporting impressive growth still despite the global slowdown. Many analysts say Malaysia's economic outlook depends on CPO prices, exports and the political landscape. Do you agree with this, and is there any factors you would add?
We've obviously been very lucky in terms of commodity prices, and we can see that over the last decade, the share of commodities and overall exports has gone up very, very sharply. But away from that, you do have two other factors. One of which is related to the elections, that the government has really ramped up spending ahead of the elections, whether it's subsidy expansion, whether it's income supplements, or capital spending, and that has been quite supportive of growth. Now, this sort of dynamic would possibly fade once the elections are concluded. Thereafter, you've had one more development, which I think is reaching its limits, which is household leverage. So household leverage in Malaysia had been increasing at a very rapid pace, but now we've gotten to a point where household debt as a share of GDP is about 76%. That's a fairly high level for an economy with a per capita income that of Malaysia. So I don't think that we will be able to sustain this kind of growth.
Sanjay, thank you very much again for joining me. Some great comments made there. Now, I'm afraid that's all we have time for at the moment, but do stay tuned to DukascopyTV for the latest financial news and Forex updates. Goodbye for now.